to the global setup, let me go across to Matt Orton, Chief Market Strategist at Raymond James Investment Management, joining us this morning. Matt, great having you. It's a difficult time, Matt. How are you maneuvering markets? How are you seeing the moves? Some sharp moves in the US. Is that more AI-led? Is that more crude-led? Is that more jobs-led? What's your sense?
Hey, good morning, Hirsch. And I think a lot of the declines that we saw at the end of last week were very squarely AI-led. When you actually decompose the S&P 500 and look at the price action on Friday, a decent chunk of the indices were actually positive. So about 50% or so of the S&P 500 was negative, and it was the semiconductors, which had been by far the biggest outperformers over the past 2 months, were the ones responsible for really leading the way down, especially on the NASDAQ. And a lot of folks have been talking about the fact that the rally in semiconductors in particular had gotten extended. We've been trading well above the 200-day moving average for quite some time at a very, very elevated pace. So it makes sense to see a correction. And honestly, I think it's healthy for the market. We had really strong fundamental results. We're now moving into a period where we're past a lot of those idiosyncratic events. We have questions with respect to what the path is for interest rates going forward. We have a large IPO that the market has to digest. We still have geopolitical concerns. So in the context of everything, it makes sense. I'm not at all concerned because at the end of the day, Hirsch, the fundamentals that support this trade are still there. And I would encourage investors to just sit on the sidelines, let this play out, and have some cash ready to redeploy into secular, durable growth going forward.
Matt, hi, I'm on. We have a geopolitical scenario building up here where the peace or the ceasefire, it seems that it no longer exists there, despite President Trump asking Israel to hold off. They have just attacked some of the areas in Lebanon. But at the same time, on the broader market, you have a SpaceX IPO which is coming in. Do you think the kind of recent sell-off in AI and tech stocks will dent demand for SpaceX, which is a $75 billion IPO?
You know, Sujit, I actually don't think there's that much to do with the SpaceX IPO and investors selling in front of it. It's actually been a very curious phenomenon over the past 2 months. Retail investors have actually largely sat out this rally. When you look at the flows that have moved into the market over the past 2 months, a lot of the positioning that we've seen move up has been hedge funds, mutual funds, and systematic type strategies. Retail positioning in the market really hasn't increased. So that tells me, number one, retail still has dry powder. Perhaps they were holding it in anticipation of this IPO. And number two, if we're going to see any sort of rebalancing or repositioning heading into SpaceX, I think it's going to be the big mega caps that take the brunt of it, just because they are the biggest weights that'll probably lose the most within the overall indices. But again, we're talking at most anywhere from 30 to 70, 80 basis points of what SpaceX is actually going to be in these indices because of free float rules, as well as cap rules that NASDAQ has. So it's not going to be that big of a weight at the end of the day. So I don't think there's that much distortion that's going to come from investors repositioning to get exposure.
And Matt, what's the take with regard to the US macro? Inflation likely to sustain, at least that's what the initial signs seem to suggest. The labor data was strong, it was robust, and therefore the new Fed chief, Kevin Warsh, has limited options in terms of how do you justify a rate cut.
Yeah, that's exactly right, Hirsch. And I think that's the indigestion you're seeing in the rate market that's translating into the equity markets. It's that we should celebrate the resilience that the US economy and, frankly, a lot of the global economy has had with respect to everything that's been thrown at it from higher oil prices and uncertainty. But that does complicate the inflationary picture, especially as oil reserves are being drawn down. And a lot of those inflationary pressures are going to start to read into a lot of the readings that the Fed pays attention to. I don't think that we're going to see rate hikes from the Fed. I would actually take the other side of where market pricing has been moving. But I do think it greatly limits Kevin Warsh's ability to institute or advocate for rate cuts this year. So I think my base case is really moved to nothing happens as long as the data doesn't get out of control, which so far that's not what we're seeing. But we'll get readings on Wednesday and we'll take it from there.
Matt, you have the Fed meet coming up next week, 16th and 17th. Of course, there may not be a rate hike immediately because the market is penciling in for an October rate hike. But do you see a substantial change in the kind of commentary and the language, and the language to be more hawkish in nature?
I would not be surprised, Sajid. I think we've seen some of the Fed governors and voting members start to have a more hawkish tune before the blackout period started on Saturday. So I think we're going to see more of that once we get the minutes. I'll be curious to see how many dissents there will be to however the statement evolves or changes at the upcoming meeting. So I think investors are going to be paying really close attention to how much consensus that Kevin Warsh can get with respect to the Fed, and how some of the members who are already leaning a little bit more hawkish react to the new Fed chair, and if the dissents grow or they start to shrink and people are more willing to just sit and wait as the data comes in. So there's a lot of really important pieces that are coming in. And you got the ECB this week too, which the market's already baking in that we're going to see a rate hike. The key for the ECB is also how hawkish are they going to be, and are they going to broadcast another rate hike later this year, which I think would be a huge mistake. But again, we'll see what they're looking at with respect to inflationary data, and that might also impact market pricing for how the Fed might be looking at some of the incoming data as well.
The way I'm looking at what you're saying, Matt, is your negative equities at this point, bonds, you believe may be a better option. The I'm reading into the commentary you're giving us, because rate cuts are certainly looking like a stretch at this point. Second piece, I want to ask you and clarify, how are you looking at India? Because India is seeing persistent FII outflows. Does the risk continue to go up with regard to outflows from India?
Yeah, Hirsch, I'd say I'm still quite constructive on equities, but particularly U.S. equities. I just think it's challenging to step in front of a lot of these events. So I encourage investors to wait, but I would be buying dips. I would have cash and I would be aggressively buying dips in companies where there are significantly strong tailwinds supporting their fundamentals. And that does sit in many cases in the semiconductor complex. So there will be opportunities. It just might not be this week. With respect to bonds, I think shorter end bonds look a little bit more attractive because I think rate hikes expectations have gone a little bit too far. With respect to India, I think India is quite interesting because, again, while at the headline index level, it has been challenged this year for sure. And I think any passive outflows you get from emerging market indices because of what's happening in Taiwan and Korea and some of the unwinds we're seeing there, that could negatively impact India, but valuations have largely reset. India, frankly, looks like a value stock to me from a global perspective. And at the single stock level, there have been a lot of themes that have actually been working. And so I would encourage investors, both domestic and global, to follow where the fundamentals have been strong and where there's a lot of, I'd say, strong fiscal support. So the build out of electricity, more power, more cables, all of that's needed to bring electric to more rural areas. The building and construction of more ports, critical for increased trade that India is trying to do. More clean energy, clearly in need as a result of what's happening. And a lot of the stocks related to those trades have actually done pretty well so far this year. So I would lean into those parts of the market that are working and have a shopping list ready for other maybe more cyclical areas that are going to be related to the Indian economy, maybe financials, once we have more clarity as the conflict starts to get to a more tenable peace deal or ceasefire.
All right, Matt, thank you so much for coming in. Have a great evening. Thanks so much for coming in late in the evening, your time, to give us that perspective.
Thanks.
All right.